My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Let's get digital. Digital. Well, that's right. Not physical, as in brick and mortar, but digital, as in e-commerce, the internet, digitization, because digital is no longer the future. It's now. At this point, it's a question of survival. Your business either goes digital, or it goes down the drain. That's why I keep coming back to this theme, including on sedate days like today, where the Dow inched 86 points, the S&P dipped 0.06%, and the NASDAQ advanced 0.23%, with or without the pandemic. And, of course, the pandemic is going to be on everybody's minds, particularly because I thought that maybe we'd have more doses faster than we're not going to. We have to start talking about some other things that can make some fabulous long-term winners. Some of this stuff is so obvious it's in your face, or at least in your hands. I mean, look, we had cell phones, right? Then we got smartphones. And now those smartphones are miniature personal computers. Something like Apple's tough to miss, right? Because iPhones are everywhere and the demand is off the charts. Same goes for the watch, for the earbuds. Yeah, we all see that. That's the technology that's in our faces. That's the purloined letter. But when I tell you business needs to go digital or go broke, I'm not talking about gadgets or anything else in the consumer side of things. No, today's digitizers are the companies that help other firms transcend their brick and mortar roots by going online. They have no choice but to get digital, because that's where the customers are. If you follow the customer, well, you're going to understand why Salesforce, which built a gigantic business by helping clients harness the power of the cloud, decided to shell out $27.7 billion for Slack Technologies, in a deal that was widely criticized by people who, frankly, I don't think read the conference calls of either. They would have known that Slack had a fantastic quarter, as did Salesforce. I think it was a brilliant move. Slack's got great business collaboration software, but they don't have the financial wherewithal to go head-to-head against Microsoft forever, right? And Microsoft Teams is embedded everywhere. Salesforce has the firepower, though, and Slack fits right in with their cloud platform. Here's what the skeptics don't understand. Salesforce.com has grown to be a $200 billion Dow Jones colossus under the leadership of Mark Benioff. But thanks to the law of large numbers and the fact that, geez, you got to keep scaling, it's very difficult for Mark to go from $200 billion to the $500 billion that I think that company can go, at least not all organically. Why? Because to most people, Salesforce is invisible. Unless you're a data scientist or you work in sales, you don't interact with their software. That's why Mark needs a visible platform, something everyone can see and something everyone can buy. Don't get me wrong. Salesforce works miracles. When we brought them into TheStreet.com, which we sold last year, we saw a 30% uptick, 30% uptick in sales almost immediately. But I saw that 30% number because I was an executive. The rank and file, they didn't see Salesforce, but they did see Slack. Everyone sees Slack. Now, the two of them are one, and that's what matters. No, the deal's not closed, but you know exactly what I mean. Of course, Salesforce isn't the only tech company that has this problem when it comes to exposure for institutional and individual investors. The digitizers that are transforming the economy are mostly invisible to everybody unless you personally have to use their software for work. For the most part, you don't see them. So if you are interested in stocks like you and I are, you tend not to own them. Instead, you go with the companies that take advantage of digitization. That's a more accessible pattern, although a lot of times it's less lucrative. But that's how you really do miss out on some great stories, of which one we're going to talk about tonight, and one of them is called Snowflake. It's probably one of the least visible companies out there, even though its stock is one of the best performers. Snowflake's in the cloud-based data warehousing business. I know, hard to understand. You need to get the For Dummies book. It's actually available on the website. But it went public with a bang in September, and since then it's fallen off the radar for many people. Company is run by a legendary technical digital expert, Frank Slootman. He is an old software hand who used to run ServiceNow. We liked that stock when it was very, very small, and that was because of Slootman. Snowflake reported some spectacular numbers last night. More on that when we speak to him later. He's one of the most self-effacing, no-nonsense CEOs we've ever had on the show. He's the one who told me that everybody needs to go digital because data is now the beating heart of the modern enterprise. Data is how we parse, understand, and act on the world. So Snowflake suddenly become essential. because its data warehousing platform federates all this information from all sorts of sources, allowing executives to make the right decision almost immediately. Google and Facebook pioneered this kind of analytics-driven thinking a long time ago. It's called programmatic, but Snowflake does it for everybody. They often team up with Salesforce to help their clients capitalize on the billions of clicks that allow their software to spot patterns, maybe who to figure out, who to call, who might be a good target, who could be the next customer. In the parlance of the Queen's Gambit, when you hire Snowflake, you're playing chess. The other guys, they're playing checkers. Of course, even if Snowflake's putting up borderline perfect numbers, you still have to figure out what to pay for perfection. Stock's certainly expensive by any conventional metric you care to name, but tech is not like the rest of the market. When you've got a fast-growing tech stock like Snowflake, or Tesla for that matter, the buyers don't play by the rules. There's no rule book, as we said the other day when I was on Scott Wapner's show. Yeah, see, they look at something like Snowflake and recognize that data has become the lifeblood of commerce, so they're willing to pay up for it, including, by the way, Berkshire Hathaway, which is the largest investor. But remember, this is a position that is not owned by Warren Buffett. That's a very big company now. Which brings me to the next invisible winner. In a world where data is treasured, companies need to protect it. Hence the strength in the cybersecurity stocks overnight. These are more companies that you don't see, but the buyers understand, so they keep bidding them up. Okta, Zscaler, CrowdStrike, all of which exploded higher in the wake of some magnificent numbers. But if these companies are so invisible, how do we even find out about them? Simple. You look at the winners in each industry and see how they're spending their money. Why is Chipotle the highest valued restaurant chain? Because it's the most digital, with a terrific online ordering system and Chipotlanes that can handle takeout. It's just fantastically. They're now making as much money per store as they were before COVID when they were jam-packed with customers. Next week, Starbucks has its biennial extravaganza. And they'll tell you all about a tech revolution that will break through the throughput bottlenecks. You think it's a coincidence that Starbucks brought in Kevin Johnson from Juniper Networks as its CEO? They brought in a technologist, not a coffee guy, for a reason. Somebody who knows more about JavaScript than Java beans. Because these stocks are more obvious, a lot of people end up owning the Chipotles and Starbuckses, and that's fantastic. You know I like people owning winning stocks, but they do it rather than owning some of these tech plays because they don't understand them, and that's fine too. But who else uses these tech plays? Well, we had PVH on last night, parent of Calvin Klein and Tommy Hilfiger. As CEO Manny Chirico explained, they pivoted hard to digital, and it saved the business. Well, pivoting hard to digital is talking about the companies that we talk about in tech. And it's the strength behind Ralph Lauren. It's another big winner today. It's why I think Tapestry, the artist formerly known as Coach, is worth buying. It's why I like the stock of Williams-Sonoma so much, and it's been a terrific winner. It's why I think that Levi Strauss is going to do well. But, man, I like the tech companies that make the pivot to digital possible even more. Don't stop at the visible winners. Buy one or two of the invisible players that help them win behind the scenes. Yes, the Oktas, the CrowdStrikes, the Zscalers, the Snowflakes, all of which just reported last night, or Salesforce the day before, or even DocuSign this very evening. These are higher risk, higher reward situations. So when one of them does not deliver, like Splunk just did last night, you have a stock that could lose 23.25% in a single session. Yeah, they're more dangerous. More risk, more reward. Bottom line, you can own the companies that have embraced digitization in order to survive. But don't forget about the tech outfits that make digitization possible in the first place, like a Salesforce. Ideally, you own some of these of both groups because we believe in diversification. And we know that when tech disappoints, the floor is a lot lower than the ceiling.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.